Here we go. Let's get to the trading day ahead and bring in our panel. Tim Seymour, founder and chief investment officer of Seymour Asset Management, also a CNBC contributor. Victoria Fernandez is the chief market strategist for Crossmark Global Investments, and Bill Lee, the chief economist at Global Economic Advisors. Great to see all of you today. Okay, so we're going to start this with data, and this has been a volatile week for markets. Let's talk a little bit here about the data that we're expecting today, PCE, GDP. Tim, what do you expect to see?
PCE is going to start to show some signs of the building inflation pressures, although, you know, it's a week also where you had the CPI number that gave everybody a lot of confidence. So BOJ, ECB, and the Fed all meet next week. The concern here is stagflation is the term that at least people are most concerned about, and equities probably don't have priced in. But I don't think today's going to be out of hand. I do think oil prices are going to remain sticky, and I think they're feeding into the economy.
William, let's talk a little bit about the labor market. I know you're concerned about what we're seeing there.
Very much so. I think the policymakers like Fed are really falling into the low hire trap. They're being faked out by the fact that so much GDP growth is being induced by productivity that fewer and fewer people are getting hired, which means with the oil tax on the fewer and fewer people can afford to consume. So what we're seeing is the beginnings of a real slowdown in the labor market, which will show up later on in the electoral votes. So that I think the Fed is really going to be behind the curve unless they start to lower rates quickly and induce more jobs to be created in the interest-sensitive sectors like construction and housing.
GDP comes out today. Victoria, we have a Fed meeting next week. What are you expecting there?
Yeah, I don't think we should be expecting much from the Fed next week. Obviously, I think they're going to be on hold with so much uncertainty going around. I think we'll see the PCE number actually be a little bit higher because it has a higher weighting on healthcare and health services, and that was the highest component of the CPI number. So with higher inflation numbers, with growth concerns, especially with the situation that we're seeing in the Middle East and what oil is going to do, I think the Fed will stay on hold, and we're pushing those expectations for a cut further and further out the year. I think we're out to September now before the first cut. So I wouldn't expect much from them next week.
Let's put up the oil boards right now and look at what WTI is doing, what Brent is doing. We're sitting above that $100 a barrel mark. For Brent, we know that the United States government has now said it's going to have a 30-day reprieve on Russian sanctions, which allows countries around the world to buy that Russian oil products without penalty. Tim, give me a sense of how big a deal this is when we're watching these oil prices soaring.
Oil price, the close yesterday was a fresh high, even despite all the volatility that seemed to be falling back. I think the conflict is escalating. As the guy that spent some time in Russia 25 years ago and knows a lot about kind of the politics here, and Russia's been the big winner so far. Also, if you look at that futures curve, people were they were at least feeling good that the backwardation that goes on in the futures curve tells you that oil prices will eventually settle back. I mean, what we've seen in the last 2 or 3 days is that there is at least less backwardation. The market is starting to price out in the future higher oil prices for longer, which feeds back into that PCE conversation and everything else we've had. So I'm not sure that we're going to see a quick return to $65 oil, which, by the way, I think in hindsight, a lot of people are now can look and see what that did as a tailwind for consumption trends. And I think this is feeding into the fallout that we've seen in equities that are most exposed to discretionary spend.
Victoria, you think that there are still opportunities in energy. It's not too late to get in?
Well, we've seen energy move, so significantly, but it was doing so before the strike started in Iran. So it does have this nice solid uptrend. We have gotten a little bit overbought, so you actually could trim some of those names, use them as a source of funds for maybe something like materials or industrials, where they're still in an uptrend, but they're coming more in an oversold position. So I wouldn't sell them out, but you could trim them if you need some cash for other areas.
Bill, how are you factoring in what might happen with gas prices as we continue to watch oil go up and the effect on consumer spending?
Well, for sure, it's a tax on consumers, and consumers are going to be cutting back on their spending. But for the markets, I think it's going to be more important that the freaked out investors that are coming into the U.S. because Trump has induced so much foreign investment with his tariffs, instead of doing foreign direct investment in key sectors, they're going to be buying treasuries instead. And that would really divert a lot of investments away from much needed growth in the key sectors that we want to build up. So feeding the government is not the same as feeding the benefit of the United States.
And where are you seeing opportunities amid all of this concern over Iran?
Oh, the opportunities are going to be here in the United States for sure, because this is still the most productive place for capital. And I think global investors will certainly want to come to the United States. My fear is that they're going to go for safe, liquid investments like treasuries instead of direct investments in semiconductors.
All right, the big stock story that we're watching this morning is Adobe. You know, it came out, they beat earnings, and then the CEO announces his exit. Tim, what do you make of it?
It tells you what the whirlwind has been going on in software stocks, and Adobe's been dead money for 3 years. It's down 60% off the highs. The story here is that they're trying to convince us that despite over 50 million monthly active users and actually beat on that number, it was a great quarter. It doesn't give you the confidence that some of the volatility in the software space for a company that's a world-class company and has been for a long time is going to change. I don't have confidence that the bounce we've seen in software, and I don't think it was that great of a bounce, is something that investors should be buying here. Adobe is a tale of a company that really has missed this opportunity.
Well, there you're seeing the shares move lower by 8%. It's notable that they, in quarter after quarter, just post pretty good results, and then the investors just don't like it. The AI fears are real on this. Does it scare you off of all the other software names, Victoria?
Yeah, I wouldn't be buying a lot in software right now. Yes, they've come down pretty significantly, so you might be tempted to go in there. But I think if you're looking for growth, maybe go back and find some of the semis that have pulled back on valuations.